That's your money saying it's time for a McDonald's run. Because with new McValue at McDonald's, you get more than you expect. Like buy a 6-piece McNuggets and add a McChicken for just $1. Your money says let's go. Get more than you expect with new McValue. Prices and participation may vary. Valid for item of equal or lesser value.
Reality radio for a really great future. We're talking real money.
Hello again, and welcome to the Talking Real Money Daily Podcast. I'm Don McDonald. Just back from a terrific trip to Seattle. Went out to Vestry's HQ and did a couple of 3 classes actually that were really well received. Thank you all. If you listen to the podcast in the area and you came out to one of the classes, thanks for being there, and we hope you enjoyed them. And speaking of classes, while I was out there, Tom and I talked a lot about what we are going to do for all of you who listen to the podcast outside of the Seattle area and can't attend classes. Well, we're working really hard on creating an ongoing series of short classes that will address a lot of these investing and financial issues that you have to deal with in life. And we'll start getting those up close to the end of, middle to the end of October. So watch for those. I'll tell you more about it on the podcast. Again, last week, no podcasts. I was out in Seattle, no studio, and just programming notes. We did not do a show on Saturday because our show, which I turn into 2 podcasts, our show was preempted by a University of Washington football game. We do the show at Como Radio in Seattle. It was preempted, so we had no shows for you last week. I'm sorry. This week, there'll be a couple of shows. There won't be the Saturday show again because we were preempted. Again, this podcast is all about kind of telling you what's going on so you can keep up with everything. And this week, I won't have a podcast on Wednesday or Thursday, or not Wednesday or Thursday, Thursday or Friday. Sorry, flying across the country for some reason just sucks the life out of me. Because on Thursday and Friday, I am spending a very large part of the day doing a student film at a film school here in the area where I live. And so I'll be 12 hours in film production. I've never done a film in my life, so even though it's not a paid gig and it's not like a feature film or anything, I'm looking forward to it, and I'll let you know. So what else do I have? I went through all the phone calls, all the backlog of phone calls that I thought was a backlog of phone calls. Well, it wasn't a backlog of phone calls. It was a bunch of calls where people hung up or were asking about tickets to classes. So the backlog is cleared. If you have a question and you want to get it answered very quickly, give me a call at 855-935-TALK anytime, 24 hours a day, 7 days a week, and leave that on our answering thing. It's not an answering machine. It's just sort of a digital recorder. And I'll put that question on the show, on the podcast. You can also send them in at talkingrealmoney.com. There's a contact us form there, and you can send questions that way. Now, today's podcast, I worked on a series of tutorials that I do. I do a feature on Como Radio every week. And so because this feature I think was so valuable, I have added it to, I've taken those feature pieces and added them to this podcast. And it's about stocks and how stocks work. So it's a 5-part series, and I'll have that for you right here. And then look forward to your calls later. 855-935-TALK. And here is our stock tutorial from Talking Real Money Features that air on Como Radio in Seattle. Investing in equities? Buying stocks? What does that mean? The term equity and stock refer to the same thing, ownership interest in a business. Say you start a small business. If you're the sole owner, you have 100% of the company's equity or value. If you have an equal partner, you each own 50% of the company's equity. That translates into ownership of half the firm's shares or stock. In a small smaller enterprise, it's easier to express ownership as a percentage. When a firm grows and takes on more owners or equity investors, percentages can get confusing, so it's easier to talk in terms of shares of stock. In a small $100,000 firm, 100 shares of stock can easily be 100% of the firm's value. But when dealing with a huge firm, take Apple for example, $100,000 or about 454 shares is 0.00001% of Apple's total value. So shares of stock are just a simple way to represent an investor's ownership percentage of a business. Over the past 90 years, a well-diversified portfolio of stocks has returned an average of over 11% per year. Now, that period includes the crash of '29, the Great Depression, World War II, 73-74 bear market, crash of '87, dot-com crash, and the more than 50% decline of the crash of '08. So, how do stocks make you money? Well, remember, a share of stock represents a small ownership stake in the underlying company. As the company makes more money, its value increases. Investors are willing to pay more per share for a company that, say, makes $100 million a year than when they were only making $10 million a year. That increased value is called a capital gain. The reason stocks have paid investors historically well is because not all firms do well. Yet, in aggregate, more firms grow than decline, and that combined growth is reflected in the plodding yet consistent growth of the world's economy. Stocks can also provide investors with a return when they distribute excess profits to shareholders in what's called a dividend. You'd think that owning a stock in a company would be relatively simple, but it can be confusingly complex. There are two basic types of stock, common and preferred. Common stock sounds so ordinary, while the word preferred actually means better. For most investors, though, common stock should be the preferred investment because common stock is the one that has the potential to grow more valuable as the underlying company makes more money. Common stock is usually voting ownership in the firm. Preferred stock is really just ownership of a stated dividend and can fluctuate a bit based on the company's fortunes, but mostly the value changes based on prevailing interest rates like a bond. The reason they're called preferred is because should a company need to suspend its dividend, preferred shareholders have priority over common shareholders should it be reinstated. However, if a company declares bankruptcy, preferred shareholders are second to last in line, with common stockholders being dead last in the list of creditors. So far this week, I've taught you what stocks are, how they make money, and the difference between common and preferred stock. So today is devoted to an even more confusing topic, the various types of preferred stock. If you recall from yesterday, preferred stock gets dividends ahead of common stocks. However, some preferred stocks, called cumulative preferred, get even more preferential treatment. Should a dividend be suspended, cumulative preferred shareholders must get all the missed dividends paid back before common shareholders can get a dividend. Then there are convertible preferred shares. Simply, this is preferred stock that can, at some date in the future and under certain circumstances, be converted into the potentially faster-growing common shares of the firm. These were designed to provide slightly higher dividends than common stock in the near term while offering a bit more capital growth potential than preferred in the future. To make things even more confusing, there is also participating preferred, adjustable preferred, perpetual, and callable preferred. With preferred stock, the meager dividend advantages for individuals are outweighed by the confusion and some financial disadvantages. The global economy has always become more valuable. Businesses make up the global economy. The best way to invest in businesses' future growth is to own their common stock. While stocks can experience huge swings up and down, in aggregate, they've risen far more than they've fallen. Over the past 90 years, if you'd invested $10,000 in the entire U.S. stock market, you would have more than $35 million today, despite multiple crashes and bear markets that scared the wits out of everyone. So how should you invest in stocks? Well, first, never own individual stocks. The stock market has always grown more valuable. Individual companies haven't. Many fail and something better takes their place. Second, forget trying to predict the future. Did you really believe that a goofy little $3,000 computer would lead to one of the largest companies in the world? Did you, or anyone else for that matter, accurately predict the crash of '08 and then jump back in early 2009? Active investing hasn't worked. Owning the entire market has. Invest in the entire global stock market with some high-quality bonds to reduce volatility, and your odds of success soar. And remember, you can call your questions in anytime, day or night, whenever the spirit moves you, at 855-935-TALK, 855-935-8255. And I appreciate you being there, appreciate you listening. Tell a friend or two, and I'll talk to you tomorrow.
Talking real money. We hope you realize advise that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.